Welcome back to the channel, Crypto Trend Trader with a quick update on Bitcoin. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Alright, so here we are looking at the 4 hour, and I've got Bitcoin chart. This is Coinbase we're currently looking at. And we're basically just, let's zoom out here a little bit. We've been essentially just cruising up on this green trend line, and we basically lost the parabolic green trend line, retested it as resistance quite a few times, and started forming this yellow parabolic trend line based on these three lows. And then we were actually able to bust through a key resistance, horizontal support resistance, and that's when we got our big move up here, which almost fulfilled the algorithm target at 96.50 for quite a few like confluence zones. But we just fell short of it and sold back off, but then we retested the green parabolic line for support, just like I was talking about, and we did get the support, but then eventually fell back below it. But again, we were able to recapture it as support, get back on top of it, and now here we've basically floated up and formed this little flag pattern. And basically, I mean, we had like a flat line resistance sell wall. We were able to bust through at one time, but then we immediately got that violent sell off, and then we came back up, couldn't quite retest it, came back up, retested it, and failed. And that's when we got like the fake out, like the stab down here. But we were able to come back up, test it again, and fail. But again, like we always say, the more times like you spend at a resistance or support, the more times you test that resistance or support, the more likely you are to break it. So now here we finally got the break of it on very we got the break of it. You know, it's higher volume on the 4 hour here, but you know, it's been very unconvincing break at this point in time. But essentially what's happening now is we're starting to build divergence on different like oscillator indicators. So at this point in time now we have a higher close, just slightly, but we have a higher close on the 4 hour than right here. But if you look at the various indicators, like the high of the indicators is at this point in time lower still. Like that, you could see the blue right here is lower than it is right there. If you go down here and look at the knife, you could see the knife is way up here, and then now the knife is substantially lower and already like topped out, coming back down. So we're likely to get like that another bounce again, that little like jagged up move. But all that's going to do is potentially just give us like a higher close on a 4 hour and distinctive divergence between the points and like the oscillator indicators. And all that divergence is representing is that it's using like less price action or less selling or buying to move the price like more in that direction. So they're not corresponding evenly. Typically you would expect like say a 1-to-1 ratio between you know, buying or selling and like the price movement in dollars. But when you start to build the divergence, essentially what's happening is there's substantially more selling or less selling coming in relationship to the price movement. So essentially what's happening is that ratio of buying or selling, depending on which way the price is moving, is becoming greater or smaller. And eventually it has to like balance back out. It's all about like essentially like reverting to the mean. So that's what divergence is all about, and basically that's what's happening right now. There's not a ton of buying coming in, but the price is slowly just moving up. And essentially what's going to happen is eventually the buying is going to run out, and then like all the people that bought in late will be trapped in this position because you'll have all the people that have been in the position finally taking profits. And that's when you get like typically like that dump that plays out, like when you see that divergence. Now what that means is you know, we're going to get like a reverse like sell-off basically in this case. Once we like get that divergence, it builds, it confirms, we'll get like a sell-off. And it doesn't necessarily mean that sell-off is going to like revert, you know, reverse the trend completely or anything like that. It just so happens that we're at the top of an area where we're likely to reverse the trend. So I think what's likely to happen right now is we're likely to come up here and hit like that 96.50 to 97.50 range and retest basically the yellow trend line. And this is an old school trend line that we've been dealing with for let me go back to it. I'm going back to the daily now. This trend line is extremely old and comes all the way up from like the actual bottom back here in 2018. So essentially you're coming from the December 2018 low up, and it's the same type of thing. You know, we were following this trend line right here. We came down and found support on it and got the bounce, and then eventually we lost it, and now it's the same exact thing. We started coming up here to retest it, and now that's where we're at. We're retesting the parabolic trend line that we broke down from. In the same way that a lot of times you'll see with like this blue line here, this horizontal support, we'll break down from that and then come back up and retest it, and then we fail, come back down, retest it, fail, retest it, find it as support, and then fails, retest it, fails. And then now, you know, here we are at two key levels. So that blue line right here, we've retested countless times and failed. So the likelihood that this time we're going to get back above it, maintain it as support, and then move to the upside is very unlikely based on statistics. And then also, same situation with the yellow line. It was support. We used it as support a bunch of times, and then we finally like violently lost it as support. So if we come back up here and we can regain this as support and the blue line as support, I'm extremely bullish at that point in time. If we get a move up right here and consolidate at this high, and then we can get like a move above that high, that's where I'm extremely bullish on this, and I think we get continuation back to retest the 14,000 highs or all-time highs. But now if we come up here, and what's most likely to happen is we're most likely to, you know, this was basically a top, and then that was like a double top. We're most likely to put in either another lower high or essentially turn this into a triple top and then sell back off. That's what's most likely to happen. And then it corresponds also with this blue line, you know, horizontal support resistance, and the yellow parabolic trend line. So I think at this point in time, the most likely thing to happen is we come up here, try to like retest and get a violent sell-off, or consolidate, poke just a little higher and take out all the stop losses, and then we sell back off. And if we can maintain this blue horizontal support line at 92.50 or whatever, that's huge. And you know, that makes me extremely bullish. If we can maintain this, we can stay above the red trend line, like descending top trend line. If you go out to the weekly time frame, you'll see this red line basically corresponds overall with actually it's not the weekly. What time frame is that? Monthly maybe? I can't remember what time frame I have it drawn in on. Yeah, okay, that's a monthly time frame. So if you go from like the monthly closes, that's where we're at right here. We're right at the top of that monthly close, and we closed previously right at it. I would expect the same thing to happen. We get a big wick above it like this. How many times have we gotten one of those? You know what I mean? There's two big wicks above right here, and then the next time we came up to it, another big wick, another big wick, another big wick, another big wick, another big wick. I mean, we could keep doing this all day. Another one right here. So what's the most likely thing to happen is, the most likely thing is we get another big wick come up here, you know, to 10.5 or something like that, and then, you know, possibly even start testing these other ones at 12, whatever. I mean, it's possible. It's not likely, but I think the likelihood of a big wick coming up here and then a massive violent sell-off to where we close this next month, which now we have basically 3 weeks left in the month. So we have the majority of a month to move up here and then sell back off below that 150 range, and that's going to print the exact same wick that we've had countless times on the same descending trend line on the monthly. And then what's going to happen after that? I think we come down here and retest the green. We retest this green line down here, and depending when it happens, you know, we're looking at basically like the 67.50 range, 67.50 sometime in like mid-July, you know, roughly. So, you know, that's how it looks to me, looking at like the long term, kind of taking a look at it. And, you know, I have been dealing with the indicators and kind of fine tuning it and messing with a couple of things. I am loving the new one. It's awesome, and it combines basically a lot of aspects of the other ones. But I do want to just touch real quick on what's going on here. As you can see, we're getting the sell signal in red, which is like the distribution zone. That is basically representing right now our daily Stokes crossing down to the downside. So as we're getting a daily Stoke cross to the downside, we also are basically getting, I'm going to zoom out here for a sec, and then I'm going to turn. I'm going to switch this over so now we can see the daily and the weekly on it. And now you'll see we basically had the distribution zone all through here, and now we're getting the hard sell as we put in divergence on the daily, and like we're already putting in, if we can close up here, especially like up above, I mean, we basically have already printed divergence, but if we close even higher than 90.50, it becomes like even more clear of a divergence. And then that's also, now you can see basically what's happening is we're getting our daily Stokes getting ready to cross to the downside. So the blue is finding like the temporary support right here, and then typically what happens is that fails and we sell off. So the blue is doing that on the purple right here. And then in the meantime, this is our weekly Stokes, and what's happening is we're getting the orange is getting ready to cross above the yellow, signaling an uptrend, as we're crossing the shorter time frame daily to the downside, signaling a downtrend. So that's basically like indecision. But a lot of times what will happen in a situation like this is you'll come up and you'll get that rejection. So we'll come up here and signal like the cross to the upside, and we'll signal the cross to the downside, and then obviously one of those two is going to get rejected. But a lot of times the longer time frame one will be what gets rejected because it's based on like the longer time frame trend. So while we were looking at this weekly chart right here, you can see the indicator oscillators are corresponding with this. So we're at the top of the range as the longer time frame is signaling an uptrend, but the shorter time frame is saying like we're exhausted and we're going to sell off. So what's most likely to happen is we get exhausted, sell back off, and then it's like a fake out on the longer time frame. But if we do get the flip on the longer time frame, that essentially gives us like a very strong signal now. But again, you have to just assume that what's been happening is going to continue happening until it doesn't. So I'm going to look at now like the weekly and the monthly on this and take a look at what's going on right now. So now this is the weekly monthly right here. And what's happening is we're getting basically the cross between the orange down below the white, which is like same exact thing. That's the trend getting exhausted on the longer time frame. So that's our monthly Stokes crossing down negative as those weekly Stokes are crossing up positive. So you see the blue is crossing above the purple right here. So now you see what's happening is we're literally at a point where we have our weekly crossing to the upside as our daily crosses to the downside, as our 4-hour, or I'm sorry, man, I said it wrong. Our monthly is crossing to the upside, is crossing to the downside, as our weekly is crossing to the upside, as our daily is crossing to the downside. So if you look at this and think, we have the monthly saying we're getting ready to go down into a confirmed downtrend cross. We have the daily saying we're getting ready to go down into a confirmed downtrend cross. Now we have the weekly that's saying we're getting ready to confirm an uptrend. As we're at resistance and all of our oscillator indicators are exhausted, that to me says we're getting ready to have a massive sell-off dump. And then on top of that, when you look at what, all the other stuff that we were just talking about, basically, about essentially how we're getting everything like lining up now for a big rejection at these 2 or 3 key resistances, because we have the down sloping red resistance, we have also the retest of the yellow parabolic trendline resistance that we broke down from, and we have our massive blue horizontal resistance that's lined up perfectly with a bunch of different fib level resistances. So to me, that just says everything right now is telling me we're getting ready for a massive dump. And then on top of that, if you want to throw fundamentals into the mix too, everyone's extremely bullish because, the miner, event coming in, we're about to have the halving, and it's like a whole big deal. But in all reality, what's actually happening is miners are capitulating, but Bitcoin self-adjusts. So in all reality, what's going to happen is it's not going to get easier for the miners that are able to like stick through this. It's the opposite. Like some of the miners go away and turn off their machines, and then the algorithm readjusts and then just readjusts the difficulty to account for the loss of the weak miners. And then it just makes it equally difficult for the amount of miners that are there. So what people don't realize is that it's designed so that it always stays just as difficult based on the amount of hash power that's getting pumped into it. So as essentially there's more hash power, as the machines become more like technologically advanced, or there just becomes more of them, like more people mining Bitcoin, as this happens, the algorithm readjusts periodically. It's like every 2 weeks, and essentially just gets harder based on how many more people is mining. So then what happens then is it balances back out. Now it's so it's even equal. So if you had like a 10% chance of mining a block before, after the algorithm adjusts, you go right back to having a 10% chance unless you have a higher percentage of the overall hash. So essentially what's happening is your percentage of hash is your likelihood of finding a block. Now it's still random. You could turn on a miner and it could find a block, the first hour it's on. It's very unlikely that that would happen, and that's why people enter mining pools, so you can have a ton of hash power like combined together, so you have a higher likelihood of finding a block between everybody, but then you have to split the block between everybody. As where if you just turn on some like piece of junk little miner and you find a block just randomly out of pure luck, you don't have to split it with anybody. You just made a ton of money. But the likelihood of that happening, you could run your machine for 5 years and never find a block, or 10, or infinitely, or whatever. But essentially what's happening is now miners are capitulating because the ones that were just getting by before or operating at a loss, but it was like quote unquote sustainable, they're realizing now that as the block gets halved, they're basically no chance that they're going to be able to stay in business. So the ones that were already not efficient, which I spoke about this, I believe it was about 2 months ago, I was talking about how we'll likely see the big miners capitulating very soon, or like big names in mining. And I'm not going to drop a name in this specific one, but as you've seen probably recently, big name in mining just recently capitulated. Now, granted, I'll do a video about him, exposing his lies and how fake he is. I talked about it before, just not in depth, but I'm not going to get into that right now. But essentially, what's going to happen now is it's going to weed out all the weak people, and then there'll be like a couple weeks before the algorithm adjusts, but then it just goes back to the same difficulty again. And that's why they say that when a miner first comes out, all the money is made when the miner first comes out, because a brand new piece of equipment comes out and everybody rushes to get this brand new piece of equipment. And if you don't get it in that first 2 weeks before the algorithm readjusts the difficulty level, you lose substantially your likelihood of finding blocks and like your profitability. Because what happens is all of a sudden you turn on these miners and it boosts the overall hash level. Like let's say, just for simplicity, all of a sudden these new miners come online and boom, it doubles the efficiency of like the mining overall. So it goes from like let's say like 100 hash to like 200 hash. So now for that 2 weeks before it adjusts, you're finding twice as many blocks. So instead of finding a block roughly every 10 minutes, a block is being found every 5 minutes for that 2 weeks. And then finally it adjusts and then it goes back to regular. Well, when it goes back to regular and it readjusts, all the old miners that were online before are now half as profitable as they were before, because it's equally difficult, but their miner is only producing half of the relative hash power of the system. So although as the hash power increases, Bitcoin network becomes substantially more like strong and difficult to be attacked, etc. That's great and everything, but it also makes it more and more difficult for a miner to come online, because it has to be a higher level of efficiency based on technology and electricity costs. And that's basically your main factors that are going into it. So everybody looks at this halving event or halving or whatever as like super bullish and everything. And it's not necessarily the case, because there's a lot of factors that people aren't taking into account. And again, this is my specific point about people have a general like idea about everything, or they might have like a really good idea, a really good understanding of one thing, but most people do not understand the big picture of crypto and the financial system and how all of this works together. I'm going to actually talk about something else really quick, because everybody keeps talking about essentially stock to flow ratio and comparing Bitcoin, not crypto, but Bitcoin to gold. And there's a reason that this doesn't work. Gold's stock to flow is based on essentially the idea. If you're not familiar with what stock to flow is, the idea is essentially that the stock is the amount of that asset that exists. So it's like the total amount of gold that's been mined, found, whatever, on all of Earth. And because gold doesn't necessarily get like expended, it might get like used in things like cell phones or computers or jewelry or whatever, but it doesn't go away. It's not expended. It doesn't ever go anywhere. So it's always still in like considered to be like the stock, although it might not be in circulation. So it's away in a vault somewhere, or it's in a cell phone somewhere or whatever. It's still part of the stock, and it doesn't go anywhere, and eventually it can be recycled back, and that goes back into the stock, is like part of the recycling. but basically the flow now represents the amount of that asset that's like produced every year. So essentially the flow would be like how much gold is mined, or depending on how you're calculating it, it would be stuff like old cell phones that are recycled, or aluminum cans, or whatever the asset you're looking at. When you recycle it, it goes back into the flow. But a lot of times that's going to actually still be considered part of the stock, but it's just going back into circulation. So essentially what that means is basically an asset over time, if it doesn't go away, you're basically getting more and more gold over time. So if there was 1 ton of gold, and then 10 years later there's 5 tons of gold, and then 10 years later there's 6 or 10 tons of gold or whatever, essentially what's happening over time is the stock is going up, but the flow is like not going exponential. So with gold, you're only ever really mining so much gold, and typically it's getting harder because you mine all the easy gold first. So like then when you go to mine gold in the same area, it's harder to get the same amount of gold. So essentially like what's happening is as the flow is decreased based on difficulty level, the stock is essentially staying the same. Therefore, the ratio is changing. So the stock to flow ratio then is what you take into account. So essentially what's happening in that case is as like technology increases with gold, or like efficiency of miners goes up, we might be able to maintain the flow for like long periods of time, or even see potentially an increase in the flow. But essentially over time, eventually that tends to diminish. The flow will go down on a long enough time frame. And what that represents is that there's only so much of this asset, and that eventually you're getting all the easy stuff, and it's just becoming exponentially harder. And no matter how much technology or how much like effort is going into it, it's costing more overall. So then what that does is it creates like essentially like an appreciation of value in that asset. So if like over time you're able to get less of an asset, like there's less of that going into the environment. So then even if the demand remains the same, if there's less of the asset in demand, the price of that asset goes up. So therefore the entire stock, all of the gold price goes up, which is what happens when it goes into demand. So as you'll see, like, the trend like oscillate for like precious metals or stocks or whatever, as the demand goes up, so does the value, not of just that gold that's being sold, but of all gold. So that's where you essentially get like the stock to flow ratio. So because gold has been around for so long and there's so much of it total, but it still has that great value. It's not like there's so much of it that it's just like laying around on the side of the street or anything. Like it's a known valuable item and like a store of value over, essentially thousands of years. So as the flow essentially doesn't go up, or in many cases, many years will decrease, as that flow is decreasing over time and the stock is becoming bigger and bigger and bigger, the ratio of the stock to flow changes so that essentially there's less of that coming into existence every year, so it becomes more and more valuable. So the idea is 1,000 years from now, gold will be exponentially more valuable. And then of course there's like the, black swan event where an asteroid hits the earth and it's made out of gold, and then all of a sudden gold loses its value and whatever. That's fundamentals. We can't take that into account. So now how does this all relate to Bitcoin? So now let's look at it as far as Bitcoin is concerned, and I'm going to show you where the flaw falls in this whole argument. Stock to flow does not work on Bitcoin in the same way. It might work in a micro time frame, but it doesn't work over time. There's a bunch of fundamental flaws in the idea behind it. So essentially you have this asset that's designed, that there's a limited supply of it. So the idea is if there's a limited supply of it, and same way as gold, you can only get so much of it with proof of work, same way as gold, and it becomes like harder and harder. And then the halvening event essentially accelerates that because it self-adjusts to become more difficult based on hash power already. And then by halving the reward, it also self-adjusts a second time to make sure that less of it is coming into existence. And then eventually we'll reach the point where diminishing returns makes it so essentially all the Bitcoin will have like been mined. Whatever, that's a whole nother situation. The same way it could happen with gold. But the idea is that, essentially the stock to flow is going to be changing the same way it does with gold, that over time, less of that asset is coming into existence. So even if the demand remains the same, the value will go up based on that, not to mention all the other like aspects that we talked about. But the main flaw with this argument is that with gold, like if someone misplaces like a bar of gold, it's not gone forever. Like eventually, somebody like will find that gold in the safe, or find it like in a coffin or something. Like the gold doesn't go away. Like it's still in existence, and it can be stored away or whatever, but it's never lost forever, essentially. Like even if it gets melted back down, it's not like unrefined back into dirt or anything. Now this is where the fundamental argument comes in with Bitcoin, that there's only ever going to be 21 million Bitcoins, and a bunch of them are lost forever, including like Satoshi's wallet or whatever. So again, without bringing fundamentals into the picture, like that essentially somebody like hacks Satoshi's wallet, or that he comes back one day, or that computers are able to like essentially like hack the passcodes and re-access like this Bitcoin that was essentially like lost forever. That's all fundamental arguments. So, but if you take the fundamentals out of it and you look at the actual technicals, your stock to flow model doesn't work now, because as time progresses, more and more of the currency of the Bitcoin like supply, or of the Bitcoin stock, is getting lost permanently over time. So people are misplacing it. People are dying and never giving away like their keys, or people don't even know they had it from back in the day when they had a faucet and they might have had 10 or 20 or 100 or 1,000 Bitcoin, or Satoshi's wallet. Like there's all these different ways that Bitcoin can just be gone forever, and crypto can be gone forever. Essentially, like you can lose your keys, or you could die, or there's just so many ways. And that's not the case with gold, and that's why stock to flow holds up, because it's not getting expended. It's not getting like removed from the supply, because essentially that ruins the whole argument, because it throws the ratio off. If over time the stock is not consistently getting larger, which it's not, it's actually probably going to get smaller. At some point in time, you'll reach a peak where more stock is coming into existence, or more flow is coming into existence, more Bitcoin is being mined than is being lost. Right now, that's probably the case, that we're probably still, mining successfully more Bitcoin than is being lost, or, the people are dying with the CD keys, or, their computer dies and they don't have a way to get at it. Whatever the situation is. But eventually that won't be the case. As the diminishing returns of mining takes the flow down so low that there's like not enough relative to the supply coming in to balance out that stock to flow, the whole model crumbles and no longer works. So, and that's like the extreme of it. But essentially over time, how do you calculate a number if you don't know it exists? So when people are counting like the stock to flow, like are you taking into account like Satoshi's wallet with like all these coins in it? Or are we considering those lost? And then if like all of a sudden one of those coins moves one day, like does it then throw off like the whole model? There's just far too much uncertainty to ever use that and consider that to be like a technical in the case of Bitcoin and crypto. So I hope I've done a good job explaining that. I probably could have done it better had I planned it out and used like graphs or charts or visual stuff like that, or even like note cards. But it's better if you get it off the cusp, and hopefully I've done a good enough job to explain it. But essentially, if anyone else has an argument against that, I'd be glad to hear it. But as far as I'm concerned, the whole idea of Bitcoin stock to flow being considered as a technical is completely shot. You could maybe use it as a fundamental. But again, I don't trade based on fundamentals or invest based on fundamentals necessarily, in this channel and what's going on here. If you want to invest in Bitcoin based on fundamentals, this is not financial advice, that's fine. But you have to understand, are you investing in something or trading something or buying something based on technicals, or are you doing it based on fundamentals? Because this whole entire channel exists because of fundamentals. Because I do believe in crypto and Bitcoin and the whole idea of it, and I am interested in all this stuff. So yes, in many ways, that's fine. I definitely acknowledge fundamentals, and they're in many ways what brought me to this space. But this channel is about technicals and the indicators and the trading and investing and all this stuff. That's all about like technicals. So it's important that you're able to distinguish those two things. And in many ways, I think that's where it's important to have multiple accounts, where you essentially have like, a trading account, a swing trading or scalping account, a hodl. Well, you really shouldn't even have a hodl account. You should have a ledger. But, essentially you get my point. It's important to distinguish these things and even write them out if that's necessary. And then you're able to have essentially an outline and follow that outline over time and have a much better idea as to where you're at, where you're heading, and what to expect. But if you start mixing in like fundamentals, and pretending that they're technicals, you're going to throw off your whole game. And it only takes one big mistake like that to wreck you forever. So, and that's where, for me, the whole idea of the halving, actually, technically, if you want to look at it as a fundamental event, is actually like bearish short term, because it pushes miners out of the game. But you could argue again that less selling pressure on Bitcoin and less supply entering the space then would result in more likely price going up over time. But again, it's just too much speculation in a space that's already filled with speculation. So, but there you have it. Looks like basically I was able to get my point across in not necessarily a relatively short time, but it looks like we're getting that move up here as well, like I talked about. So hopefully we could get at some point in time, I'd like to see us really at least come up to 96.20, 97.50, somewhere around there. But we'll see if that happens. It may not be the case, but we'll see over time. And I have been toying around quite a bit with the new indicator and really enjoying it. And it is everything I hoped for and more. And as I really fine tune this thing, we're really going to see. And you can kind of see, actually, like just a quick little caveat, like as I'm laid in right here, you can see the difference too. This signal right here would not have got triggered at all normally based on crosses. That's the multi-time frame SIG. So that's the daily SIG getting triggered right there on the 4-hour time frame, in the same way that this one is. This purple one right here, that's the daily getting triggered on the 4-hour time frame. So that is the daily cross going down as the 4-hour time frame enters the distribution zone, as the weekly time frame is getting ready to cross to the upside, as the monthly time frame is crossing to the downside. So that's just absolute insanity. And I honestly do not blame anyone right now for not taking positions in this market, although we are at a key pivot. And like I've said in many videos, often key pivots on the market are the best place to take positions, because you don't have to go far to know if you're right or wrong. So I will be looking for key areas at the top of this trend to take positions, short positions to the downside, and at the bottom of this area, and key fib levels when we do get the retracement, to take long positions to the upside. But at this point in time, there's too many things pointing to the downside and not enough pointing to the upside for me to all of a sudden get bullish at the top of a long trend that we've been in. This has been a great move. It's been very profitable for many people, including myself. I hope it has been for many of the followers of the channel and participants as well. But there is no reason to get greedy in a situation like this, where we're essentially getting quite a few strong signals to the downside as well as some to the upside. If anything, I think this is the best time to go neutral. So, but this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. I do just want to touch on one more thing real quick. As you can see right here, something's happening on the TJD, TD, MACD on the 4-hour. We are essentially flipped the histogram back over green, and we are reapproaching the slope line, and we've actually managed to, from below the slope line, flip it back over blue. So that's sort of, again, a mixed signal. Typically, if we were coming back up to retest the slope line and it was still red, it would act as resistance. But often when you come up to retest it, if it turns blue and then you get up to it, it won't act as resistance, and then you'll get continuation, and we will get like continuation blue right here, and we'll see actually like the same thing happen here, where the histogram starts to build strength, and we'll essentially get like that marched up parabolic move, in which case I could see us like really getting that big boy move to the upside that we talked about. It is less likely at this point in time, but I think like somewhere in like, you know, this like 10,000 to like 13,000 range could potentially happen. But you know, again, that's very unlikely at this point in time. You know, we would have to look at that level by level, and I think more than likely at this point in time, we would find like resistance at the key fib and our yellow long-term parabolic resistance, as well as our purple key fib as well. So here you have it, guys. Crypto trend trader, looking out for that divergence. You know, you would think that if we were getting like a breakout right here, that we would see like a strong continuation move to the upside, but you could consider this as just consolidation on top of a resistance that was just broken, acting as support, and now we're going to get continuation, which is the most likely situation at this point in time. And I think it's very likely that we're going to see that 97.50 to 97.25 range, and after that, more than likely going to see our retracement. And what we need to pay attention to is whether it's going to be a micro retracement inside this you know, wave that we got up here, or a 5-wave structure that we essentially got up here, or whether it's going to be like macro retracement, and we're going to take out like the previous low and essentially get like continuation in the overall downtrend to the downside that we've been in for, you know, at this point in time, years. And I do want to just pop this up here again real quick. I had mentioned this in a previous video and was talking about how I don't normally like to look at like fractals like this specifically, but look how we were talking about how this essentially gives us kind of like an idea of what the algorithms are doing. You can kind of see as we sort of match this up, this is basically what I had done. I basically put it like right around here where this was like our wave 3 and we were going to get a wave 5, or essentially that, you know, I had said like we're not going to count like this massive wick right here, because that was basically like, you know, I think like the cascading waterfall of like over leveraged traders getting wiped out. But essentially this is, you know, this is basically back to what we're looking at, like the 1, 2, 3, 4, 5, and then that's our final continuation. So, and again, it doesn't line up perfect. You don't want to trade off of something like this. It's too rough, but it's just basically giving you like, without like that clear cut movements in the price action like we got right here, it still gives you a very good idea as to what's happening with like bots and algorithms. Although it's like more choppy and not as like identifiable to the human eye, when you start putting like you know, something like a fractal up here, you can get a better idea as to what's really going on, and you know, where we can potentially expect the trend to max out. And I think that's very close to where we're at now. So, crypto trend trader, and I'm out of here.